Hello, everyone, and welcome to another Alto Trading Live strategy session. This is Richard Van Rich here with Mr. Jeff Tompkins. We're really excited to have you guys with us here tonight. Got a lot of great stuff to go over. Let's see. If this is your first time on our session, and notice your microphone is muted. That's so we can hear Jeff and I talk. But there is a Q&A box. So throughout the evening, if you have any questions, put those in the Q&A box and we can check those out. Now, you can use the chat box as well, but we're more likely to see them in Q&A. If you have to hop off for any reason, you get bumped, don't worry, this is recorded and will be available in the members area later tonight and on YouTube sometime tomorrow. So if you're on YouTube watching, please like and subscribe for videos. Let's see, I'm gonna make sure you guys can hear me and see my screen. So if you can, pull up the chat box and just put a yes or one or how you doing or where you're at or anything. So we know that you guys can hear us. Philip, good to go. All right, Moshi. All right, we got a lot of folks on tonight. Awesome. If you have any questions about your own account, access to Zillion or Trade Trend or anything about any trade alerts, anything like that, email support@altostrading.com and we'll get to those sometime tomorrow. So before I bring on Jeff, let me go through my disclaimer here. Each week, I hope it sounds better and better, but I'll watch the replays and it just makes me cringe. Trading securities and options involve risk. Prior to buying and selling an option, investors must receive a copy of characteristics and risk standards options. Investors need a broker to trade securities and options must meet suitability requirements. Past results are not necessarily indicative of future performance. Performance figures are based on actual trades, including real money results. Due to time-critical nature of trading, broker fees are not typically other subscribers. There's no guarantee subscribers will mirror performance. The performance numbers shown are based on trades users could enter based on the trade signals. All right, with that being said, let me get it over to Jeff until I've had my coffee tonight. Hopefully you got your Red Bull going over there.
I got my tea.
You got your tea? What kind of tea you got?
Green tea.
Guess what I got too? I got the green matcha tea.
Oh yeah, I love matcha.
Yeah. Like first time I had matcha, I just had some. My wife's like, I don't know if you should have that because I usually have like hard for me to go to sleep sometimes. It was like 3 o'clock in the morning and I was like wide awake and I was just like, go to sleep. For like 2 days I couldn't sleep.
Yeah, I'm sensitive to caffeine. I gotta watch my caffeine intake in the afternoons.
Yeah. So how was your weekend?
Oh, not too bad.
I don't think I talked to you since last week.
Yeah, we're still getting like, I don't know, somewhere between fall and winter weather here in Boise.
Really?
Yeah, it's like it's snowed. It's snowing. It snowed in April. I mean, it's crazy.
Oh man, it's super hot over here. It's like last night at 8:30, it was still like 84 degrees here in Atlanta.
That's why they call it Hot Atlanta.
Yeah, man, it's brutal. Humidity's kicking on.
Yeah.
Philip said it snowed in Pennsylvania too.
Yeah, well, send some of your weather my way. All right. Thanks for being on, everyone. Welcome. And geez, we just saw everybody last Thursday. So nice to see all of you back. Most of you. Got a big group on though. So we'll start out looking at the markets. Once again, good timing. We've got some major support levels that we're working with right now. So we'll discuss those and what it means for the near to medium term, and then we'll look at the CBOE volatility index, the VIX. Interesting things happening with the VIX in conjunction with the support on the S&P. So very noteworthy. And we're going to focus a little bit on money management tonight. We often focus on trade setups or trade trend buy sell signals or certain particular option strategies. And those are open topics as always, but we're going to focus a little bit about scaling in and out of trades and money management and position management tonight. Because there's some cool little tricks that we can use regardless of what strategy or system that we deploy. So I think that this is going to be really valuable, especially right now. This is a good topic for periods in the market where we're near a major level, or even for individual securities, like for trading stocks or futures or whatever. It can be applied really universally. So that's kind of the beauty of it, and I think is a good topic for it's a timely topic for this week. And then we'll open it up for our ticker roundtable and wrap up with Q&A. So let's see. Let's get over to charts. And I'll flip off my cam here.
I think we're money management, Jeff. You just let it ride.
Let it ride, yeah. And that's only when we're in Vegas.
That's right.
When we're at the Traders Expo in Vegas, that's I think the only time we let it ride.
That's right.
Take unnecessary risk where we know we don't have an edge.
For me, I think I hate losing money. So like, it's like every time I go to Vegas, I never gamble.
I've noticed that. I don't think I've ever seen you gamble once.
I know. Like I used to gamble a lot. Not that I have a problem. I just like I just got to where I just didn't enjoy it. But like when it comes to like the dessert card, I always usually let that ride.
Well, interestingly, I was never like a big gambler, but I enjoyed it, and
well, you're good at it. You always make money.
Well, not always, but I stick to the games where I have, the casino has the least edge. So I play craps and blackjack. Although I confess I played roulette while I was last in Las Vegas, but based on the influence of the people I was
like
with.
A vodka decision right there.
And but interestingly, like the more I like traded, and as I started trading professionally, I've gambled less and less because I'm not comfortable, with somebody having an edge over me.
Yeah.
I want to be the one that has the edge. So that's why I think I've kind of stopped gambling, or when I do, I gamble just very little. But
that's awesome. Smart.
Yeah, Robert said, why do they call it craps? Because all of the people are saying, oh crap.
It's about right.
Yeah, but so here's a little kind of I don't know what you call it, like a tidbit of wisdom, I guess. But craps is the only casino game, well, at least that I'm aware of. I think there might be some bets in baccarat, and if you exclude, of course, like poker, craps I think is one of the only table games that there's a bet on the table that doesn't have a statistical house edge, and that's the odds bet. So if you guys know how to play craps, if you bet the pass line bet, and once a point's established, you can place an odds, or you can back it up with odds, place an odds bet behind your craps line bet, or your pass line bet, sorry. And the house doesn't have any advantage over you on that bet. So kind of an interesting.
That's interesting.
Of course, what they do to counter that is they place limits on the table. So you can't use like a martingale system where if you had a lot of money, you could theoretically double up your bet every time until you won, and come out ahead.
Right.
So they always, and a great topic for tonight, right? Money management. So
that's right.
It goes to show what money management, how it can impact any system, whether it's on the craps table or in the market. So, but the good news in the market, there's no limits, right? Our limit is our available capital. So, yeah, I mean, but if you use it wisely, then it's a great principle to adhere to and understand and implement, when you're trading. So, yeah.
I mean, I saw something. I read something recently. Someone said like even if you flip the quarter for your trades and just use good money management, you're actually fairly possible for you to be very profitable for at least a while just doing that.
Yeah.
This would be a good money management. So like imagine good money management using trade trend and all the things you're learning. It really does give you a big edge over the rest of the market.
Yeah. Yeah. There's different edges that we gain, right? We, obviously entries and exits and position management. So that's on more of the trade side. And then the often overlooked money management, which in fact can give us more of an edge than the actual entries and exits. And that's something that, you don't see often promoted through marketing. There aren't very many marketing campaigns out there that are trying to sell money management strategies. They're trying to sell, entries and exits, and it's ironic because money management actually is really in my opinion, more the key to success.
Yeah.
So, not to diminish, obviously, technical analysis and entries and exits and position management, but it needs to be done in conjunction with good money management. Because you can really take, and actually I've done studies on this. You can take really terrible systems that are either equal to throwing darts at a dartboard or worse than flipping a coin, and make them okay. You can turn those into positive expectancy or profitable systems with money management. So just goes to show that really is a crucial factor. So we'll talk about that tonight, and there's so many different things. I mean, we could do many sessions, and we will do more on this topic. And we'll start out with kind of some basics tonight, and we're going to look at scaling in and out, and then we'll get, in future sessions, get more in depth on some of these money management topics. So looking at the S&P, we've rejected a major support level, right around 40.50 to 40.75. And so looking back at the S&P last time the S&P was at that level, which was around May, mid-May of last year, we see this really big run up. And let me actually expand our time frame out beyond a year to get a better picture. So, we had this really strong bull market uptrend that topped out at the beginning of this year on the S&P, and this year we've obviously we're down significantly from recent all-time highs that were hit earlier this year, and we're in a ranging market. I'll explain why we're in a range and not a downtrend. So let me do that real quick, and then I'll redraw that support line. So here's the all-time high. So you'll notice that if you look at the momentum shifts, or the kind of many trends within the price action, the highs and lows of the year, with a trend, with a defined trend, you'll see if it's a downtrend, lower lows, lower highs at these turning points. And that's how we started out in January and February, right? So where that shifted was at the beginning of March. So you'll see here that rather than make a lower low in early March, we actually shifted the structure in March. And you'll see here that we would have had to come down here for this downtrend to still be intact, below the low from February, and we didn't. So then we moved back up, and then what happened here in late March is we posted a swing high, or a supply point where there was excess supply in the market, and sellers drove prices back down. That exceeded this swing high or supply point from late January, early February. And that's why we're in a range, because that downtrend structure was broken. And this is significant enough, I think, to warrant drawing there. And we've come back down. So this is more of a range. And right now we're at the bottom of it. If this swing higher supply point in March hadn't exceeded the one from February and late January, early February, then the downtrend would have still been intact, but it did. So this is a range. So let's look at the high and low of the range and the support and resistance. And I'll point out too that yesterday there was a major rejection of a century market 4100. So we're going to use that level as a barometer for support and buying, and buyers coming in after this recent sell-off that we've seen in April. And you'll see that again was in play back in April, May of last year. And there was a move off that 4100 level up into the 4800. So over 700 point move on the S&P from that level. So again, because of the overall shift in market structure and sentiment from secular bull to secular bear, I don't expect that we'll get back up to 4,800, and that I'm not counting that as the top of the range, but I think this is a noteworthy support level at 4,100. So that's kind of the bottom of our range right now that we're going to be watching near term. And as we discussed in previous weeks, the 4,600 is kind of, 4,600 to 4,650 is kind of that zone at the top of the range, because those are near the highs of the year following the sell-off in January. So we've got three highs from this year that are significant. Obviously, the first one, which is the all-time high in the S&P. Then we've got this double top here in early February and then mid-March. And now we're down here at the bottom at this 4,100 support with a close today at a quarter century mark, 4,175. So those are support areas to be watching this week. And then as far as resistance, we have some nearby levels to be watching around 4,200. So we didn't get above that today. There was a lot of choppiness today, most likely because of that 4,200 level. So we just slightly breached it to the upside on the S&P today, 4,200 and a dime. And that's one to be watching for resistance and a break tomorrow. So you'll see here that there was some nearby over the course of the past year or so support there that it's turned into resistance. So if we can break and sustain a break above 4,200, that's a win for the bulls. If 4,200 remains a resistance and we move back down into 4,100 or below, then that's a win for the bears. And then the other thing to consider here is we're very close, obviously, to a millennial market 4,000. So this is one we really want to be watching closely, more medium term. Potentially could play with this level by the end of the week, probably not likely. So really for this week, keep an eye on 4,200 and 4,100. And again, a break above 4,200 bullish, break below 4,100 bearish, and particularly a break below the low from yesterday, which was 40.6250, 51 to be exact.
Hey Jeff, I know they're projecting another half-point raise tomorrow.
Mm-hmm.
The interest rate, you think that could possibly push us down? Or
I think that's been priced in already, and it could certainly lead to volatility just around the expected announcement, but I don't expect that. Certainly if it were to get postponed, that'd be very bullish. But if they follow through with that, I think it's priced in and it's expected, and wouldn't prevent the markets from pushing higher. So that's again, and that, important consideration on the fundamental level. So keep an eye on that tomorrow, but it's probably priced in. And the only real surprise is if they didn't do it, and that could push things higher. But as we'll look at the VIX here shortly, the reason I'm short-term bullish is because of this support level and being at the lower end of this range. And then as we look at the VIX, you'll see why, as the VIX is retreating off of a major resistance level. So let's actually just look at the VIX right now. And then we'll look at the Nasdaq. All right, so this is again a level and or more so a zone that we've been watching closely in past sessions. And you'll see that this was strongly rejected yesterday. So when we see the VIX reject a zone or a level, in the context of the S&P moving off a lower support level because of that inverse correlation, that's our added confirmation that we expect to see some degree of a move up in the market. And we're seeing that right now. So until the VIX gets back down into lower levels, like the 25 to 20 zone, and 25 is a support, and then 20. But until we see it get back down there, unless something derails this rebound off the lower level of the zone, then I think we'll continue to see upward price movement. But there's very strong support in the VIX at 25. So if the VIX continues to retreat lower, watch that in combination with the S&P moving higher into any resistance zones like that 4,200 that we looked at, or anything above that. So very short-term bullish. And I don't think there's going to be any real surprises tomorrow with the FOMC meeting and the rate announcement. So this is a good sign near term for the bulls. And you'll see that in previous weeks where we were up at these higher levels on the VIX, between 35 and 40, we've seen major retreats. Major being that we went back down into 25, that 25 to 20 zone, or even below 20. And so I expect we're going to see the VIX retreat lower again, back into those zones. All right, and then the Nasdaq, similar. Also in a range for the reasons that I explained on the S&P. What's significant here is we're closer to a millennial level, 13,000, and we've talked about that, in depth on past sessions. So 13,000 is the lower level of the zone on the VIX or on the Nasdaq. And then 15,000 is the higher end of that zone, of that range. So we've got, room to move up off this 13,000 level if it holds. And you'll see what happened there back again in May of last year in terms of the move up off that level. So very significant. Yeah, SP, I do trade the VIX with options. So you can't actually trade shares of the VIX, but I use options on the VIX for portfolio hedging and speculation. So often I'll sell call spreads or naked calls on the VIX at high levels. And that's something that I actually covered in last week's session. So you can review the recording for that. Actually, I think we've done a couple sessions in the last month or two around strategies with the VIX. Yeah, like ratio back spreads and things. We did a ratio back spread strategy for the VIX, I don't know, 2 or 3 sessions ago.
Yeah, I think it was like 3. You can see it on YouTube. I think they're all on YouTube. You can go back and check them out.
Yeah, I think last week's is not up. I got to get that one up. And eventually we're going to start live recording these to YouTube so that they'll go directly into our channel. But we'll get that one up tonight or tomorrow, as well as the one from today. But I think the one that we did I know the one we did ratio back spreads, that session is the ratio back spreads on the VIX is posted in the YouTube channel. So let's watch 13,000 really closely this week as a support level and see if it holds or breaks. If it breaks, then we've got a lot of room down, to go. So let's zoom out. So that we're looking at 2 years worth of daily data. So 13,000. So if that breaks, we're looking at right around 12,250 is our next major support on the Nasdaq. But so far it's holding, and we've had some major moves up off that 13,000 level. So we'll keep an eye on that. If that breaks and the Nasdaq goes lower, then 12,250 is the zone to be looking at for support. All right. So any questions on the market overview? And then we'll get into how we can use these levels to scale in, because the beauty of scaling in is you don't have to be precise or even right on your entries. It can actually allow you to more flexibility to get in and out of trades without having to do so much prediction.
I was like, Robert asked if you could take a look at the Dow or the Russell.
Yeah. Yeah, they're all going to look pretty similar. On all the major indices, we're kind of at the bottom of this range. So same thing with, and they're all ranging. We're in more of a ranging market than a defined trend. So there's the range of the DJX. Oops, I used the future symbol. And the Russell tends to range more than the other indices. You can see last year we were pretty much in a range the entire year. That broke to a lower range, which again we're trading at the bottom of that range currently. So that's also the Russell's a good one to look at too, as a barometer for the Nasdaq and the S&P. So because the Russell does range so frequently and trends less than the S&P and Nasdaq, when we're at the bottom of a range on the Russell, at the same time we're at the bottom of a range on the Nasdaq and the S&P, that can be also a good barometer for sentiment in terms of near-term expected moves. So again, as long as these lower support levels of these ranges hold, we expect to see a move back towards the top of the range, and that analysis would change, and the whole market structure would be different if these lower support levels were to break. But so far they're holding, and not only are they holding, we're seeing false breaks, which lends more weight to it. So like here on the Russell, you'll see we've got this lower end of the range from the double bottom back in January and February of this year, serving as support that was slightly broken end of last month, I guess, because we're now in May, but then moving back up above into that range, back above that level. And we saw that too, like on the S&P. So we're at a potential inflection point on all the major indices, and just want to keep an eye on those levels.
That's all I got.
Okay, so let's talk about scaling in. So everyone on the session tonight probably uses different systems and strategies, and obviously we have a lot of trade trend users that use the buy and sell advanced signals. And let's go back over to the S&P. Actually, I think the Nasdaq had one. Yeah. But it's now, as of today, expired because we didn't come up and trade above to the entry. So the buy stop limit would have been at 13,581 from this buy warning back on April 28th. And we didn't get above that over the course of the next 3 trading days. So this one is now null, no longer an active or valid buy signal. And there's still an open short signal on the Nasdaq. You can see the notification came in April 22nd, triggered, that was a Friday, triggered the next trading day, Monday the 25th, and currently still open. I don't think this one has much more room to run down, being that it's at the lower end of this range or channel and this major level of support. But let's say, we're using buy signals from trade trend or a support or resistance level to make decisions on entries into a trade. I generally don't enter, it depends on the strategy and the outlook and expectation, and where the market or security that I'm trading is relative to a support or resistance level. But I generally don't jump in all at once. I prefer to scale, and scaling offers a number of advantages. Number one, if we're not exactly right, let's say, for instance, we're taking a buy signal off a support level, and there's always going to be lower levels of support anytime that we're trading at or near a support level, and we're looking at a long entry for an anticipated up move. And while that may at the time be an ideal place to enter, we can't be right 100% of the time. So there's always the chance that support breaks, and then the security trades lower into lower levels of support. And that's where scaling in can be advantageous, is we don't necessarily have to be exactly right on our entry. We can be wrong and still give ourselves a chance to lower our cost basis and get in and add to the position at lower price levels for a long setup. And conversely, for a short setup, if we're at a resistance area, we can do the same thing. And if we're wrong and the market continues to move up, then we can go ahead and scale in at higher levels of resistance. So that offers us a statistical edge as far as entry, assuming we're sticking to our plan. There's caveats. We don't want to just do that blindly. We need to have a plan in place that if we keep moving lower, and at some point, for a long setup, for instance, and we're scaling into a long position, if at some point that market structure breaks and there is a real downtrend in the security, we don't want to just blindly scale in with a hope and a prayer. We want to, obviously have our risk management in place as well. So if we exceed our risk threshold, then you still want to have that in place and have a stop loss and a point where you decide, well, I'm just not going to scale in anymore. And even if that happens, the good news is you'll end up, like, let's say you're scaling into a long position and it doesn't work out. You'll end up better off than if you jumped all in at once at the initial entry point, higher up in price, because you've lowered your cost basis by scaling in. And I'll talk about what that looks like and different ways to do it. And even if you do get stopped out of a trade, the overall difference between your entry price, which you've averaged down or dollar cost averaged on a long potential long trade, would be lower than if you jumped all in it right off the bat. So the trade-off is, of course, if you scale in and you don't open the full allotment at one time right off the bat, and it does move in your favor, then unless you have a plan to scale in at higher prices, the trade-off would be that you would have done better if you entered all at once. But being that that's a trade-off, that's okay, because you can still make money on the trade. And overall, in my opinion, it's better to scale in because it gives you an edge in both directions, where you can be profitable if it moves in the anticipated direction, and experience less of a loss or even a better profit if it moves lower, even if you get stopped out or it reverses at a lower price point. So those are the advantages of scaling, and that's just on the entry. It works that way on an exit too, because we never know for certain how far a position will move in one direction. And so that's the advantage it gives us on the exit, is we can do things like scaling out and then managing any existing open position with a trailing stop, or with higher levels of resistance on a long trade or lower levels of support on a short trade. So there's a lot of ways to do that, obviously. So we'll just talk about some basics, and we can use the current market as a kind of a barometer for what that looks like. So I'll just go back over to the S&P, and being that we're at this strong support level at 4,100, and if you did your homework and map this out from previous levels of support back in February and May of last year, and you can see that probably institutional buyers came in here at this 4,100 level and drove prices up yesterday and today. You could have potentially entered that in advance, entered a buy order at that level. And let's say that you did that, but you obviously don't know if that's going to hold in advance. We just now know in hindsight that it did. So let's say, on the S&P, and of course, you'd have to have a very large account to buy 1,000 shares of the SPX. But in fact, let's just use the SPY because it's the ETF for the S&P, and it trades at lower prices. But even still, 1,000 shares at current prices would cost you over $400,000. So we're just going to use that for demonstration purposes. But let's say that you determine that your risk based on your entry and your stop and your account size warranted trading 1,000 shares. Well, instead of entering those 1,000 shares at a support level or on a trade trend buy signal, scaling in, as I just discussed, is something we can use to our advantage if we're not right at that point in time. And so a simple way to do that would be to enter half of your position at a level or on a buy signal. And then if that level doesn't hold and we move into lower support levels, use those for entries for future, adding to the position in the future. And that can be done, scaling obviously can be done in lots of different ways. So you could do like a 50-50 where you do half the position at one level, and then if it moves lower, the other half at the next, or you could do it even, you could chop it up more and do like, start with 50, do 25% at the next lower level. And then if that holds or doesn't hold and goes lower, then you could do the other 25%. So you can chop it up, kind of slice it and dice it lots of different ways. But what you're basically doing is you're, as long as the story hasn't changed and your analysis is, not been affected in terms of entry, you can lower your cost basis. You're basically dollar cost averaging. You just wouldn't want to do that if for instance, your sentiment changes from bullish to bearish, or for a short trade, vice versa. So scaling in can give us a lot of advantages there. Now, that's one way to scale in terms of entry. Another way is, let's say that you scale in, and let me see if I can find an example here. Let me just kind of use this recent one. So let's say that you scale in to a trade that maybe in the very beginning might move against you a little bit, or even takes off right off the bat and really makes a stronger move up. You can scale into those as well. So like here was a buy signal. Got a little bit of the move up there in late February, early March, but then a bit of a retracement, but this support still held. So we never broke it. And then we move up again, and there's another buy signal. So that could also serve as any subsequent buy signals, or a break of a resistance level could also serve as an opportunity to scale in on a momentum move. So those are kind of the two different methodologies for scaling. You could do it in a trade that's already successful, if a resistance level is broken, or if another buy signal comes in and you're already in a long position, or you can use it, as I mentioned previously, with a break of a lower support to lower your cost basis. So in this case, it wouldn't be lowering your cost basis, it would be raising it a bit, but you'd be adding to your position on a subsequent buy signal where there's follow through on the momentum. So that would be kind of an example of where you could use that. And here's another one on the short side, right? So here was a short right off a resistance on the SPY. Worked out nicely. And this one actually was hit the trailing stop, so it would have been a profitable trade on this signal. And then a buy came in. But if you had used options, let's say like you were buying puts, because you can scale in with any instrument, right? It doesn't just have to be shares of the stock or the ETF. You can scale in with options too, and I actually do that. I scale my options trades as well. And it's very easy to do just by adding contracts or subtracting contracts. But let's say, you had bought puts on this sell signal, made a nice move, and then another one comes in. That's a scaling opportunity as well, down into this support. So scaling makes sense in two different scenarios, right? If you're wrong right off the bat, you can scale in. This one wasn't wrong right off the bat, but let's say it had been and it went up. The SPY went back up into higher levels of resistance. That could have been a scaling opportunity, or you can use it, like I said, after a successful move in the anticipated direction. So in this case, the SPY did go down after this sell signal, and then we got another one, and an opportunity to potentially scale in to lower levels of support. So that's basically how it works on the entry. And then we can do the same for the exit. So if let me zoom out. And where I would use scaling for an exit is if we're not quite, like, we'll use a long trade, for example. If we're in a long position, if we're not quite at a resistance level, and I think there's more room for it to run, or we're looking at the trade trend trailing stop, as volatility starts to dry up, we can scale out of the trade as well and leave part of it open to continue moving lower. And typically when I do that, I'll move my stop loss to at least a break even, or potentially even past the break even point, after taking profits on a portion of the position. Usually with scaling, I'll do like 50-50. So I might close half the position at a predetermined level, usually like on a short trade at a support level, and then see if the security moves below that support to the next, lower level of support, and keep that second half of the position open while moving the trailing stop to lock in either a break even or profits on that second half of the trade. So like here, that could have been implemented. Here was a short sell signal back on February 11th on the SPY. Got a nice move right off the bat, pretty much. I mean, a little bit of a 2-day retracement there before a continuation of the move. But as the thing is breaking lower, and I'm mapping out my support and resistance levels, like right here, I would have seen that there was a major level of support. And if I had taken a short trade, although the SPY moved, over 20 points lower from that level of support, it eventually reversed, right? So I could have used that level as a scaling opportunity to get a scaling out opportunity to get out of half of the position, and then left the other half open and placed the subsequent profit target at a lower support level. And there was a couple here, but I would have been really eyeing this one as a scale out down here around 415, because you'll see that was support from back in June. And the SPY came down and surpassed that level and almost hit 410. But you could see how that could have been used as an opportunity to take profits at a lower level on a short position from this sell signal at lower levels, and then also reduce the risk on the overall position while booking profits on the first half, because this was a successful move based on this signal. So those are some of the advantage of scaling in and out, and how it can be used on both sides, on the entry and the exit, and help you manage risk, increase profit potential, lower the amount of a losing trade by dollar cost averaging. So it offers a lot of advantages in different outcomes. And so wanted to really emphasize that. And we'll get into it deeper and more of the nuances of scaling, but wanted to introduce that this week And then in subsequent weeks, we'll talk more about some of the more advanced scaling techniques that we can use. But those are the basics, and I think are important to consider and understand for any trade entry or exit. All right, so I'll pause there, see if there are any questions, and then we can on scaling, and then we can open it up to ticker roundtable and even potentially look at some of the tickers as scaling opportunities.
And maybe you want to dedicate more time to it, but someone asked a question about, like, let's say they are more of an options trader, they don't like to trade stocks. You would just kind of similar, maybe just do 2 contracts and then maybe scale in one at a time.
Yeah, so I think that is a really great topic for a future live session, because scaling, I think, in my opinion, even provides more advantage with options. And I do a lot of scaling with options. And the reason being, when you make adjustments to options trades, scaling can be really beneficial. So like I mentioned, I do options on the VIX where I'll sell call spreads or calls. The challenge with selling calls or call spreads on the VIX is that you get volatility skew, where when the VIX spikes, the market makers know that the VIX will eventually retreat lower. And so unlike a stock or an ETF that moves lower, where future expirations in the option cycle have higher options prices, it's the opposite with the VIX, because the expectation is the VIX is eventually going to, volatility is not going to stay elevated forever. It's going to eventually drop back down. So for that reason, future options expirations tend to have lower premium. So it can make it difficult to use certain adjustments like rolling to achieve a net credit. But when you scale, it makes it possible. So like if you sell a naked call or a call spread on the VIX, and the VIX doesn't drop as you expect, when you go to adjust that trade, the future expiration cycles are going to have premiums that are lower, which makes it more difficult to roll for the net credit. So the way to counteract that is to scale into a rolling position. So you just add contracts to the trade. But again, with a caveat, you don't want to do it beyond or past your risk threshold. That's not the idea of scaling, is to add more risk than you were ever initially willing to take. It's to stay within your risk threshold. And if you're still within it, add contracts to the position to overcome volatility skew. So that's a more advanced topic, and also a really good one for future live session. But yeah, definitely scaling it. And even in the absence of volatility skew, scaling can be very advantageous with options. So we'll focus on that in the coming weeks.
Yeah, I thought so. I know it's kind of a loaded question. There's so many nuances, so many different variables to it that kind of deserves its own session.
Yeah, absolutely.
Well, let's see. That first one came in earlier. Someone, I think it was Moshi, wanted to see gold.
Okay. I'm going to flip over to the Zillion dashboard, refresh our data, and forgot last week I wanted to take a look at our sector performers. So we'll take a look at that, and then we can we'll take a look at gold. Okay, so right now our top performing sectors are energy and materials. And those are the ETFs for those: XLE, XLB. So those might be good ones to focus on in the near term, being that, again, do your homework, do the analysis, map out your support and resistance, and look for the buy signals off support, sell signals off resistance. And then our underperformers, consumer discretionary, real estate, and utilities, are getting hit pretty hard, even in the context of this rebound off the lower range of the channel that we're in right now. So these are ones to keep an eye on for top performers and underperformers. And then let's take a look at gold. I guess we can just look at GDX. and this is, you know, a good example. So we've got a sell off of the range is really here, off the high end of this range. And now we're just like the major indices, rebounding off the lower end of the range on gold. No buy signal currently. In fact, there's an open. Oh no, that was taken out. Sorry, a few days ago. There was on this previous sell signal, hit the trailing stop. So that was a nice one. But currently no buy signal. I want to be waiting for a buy signal from a trade trend off this lower level. But in terms of support and buying pressure, there's a very strong level of that here, right around 34 on GDX. So this is the gold miner ETF. We'll look at GLD too, but expect, you know, there was a rejection yesterday and then follow through today. So potentially expect to see a move back up in the GDX, but also want to be keeping an eye on resistance. There's a strong resistance around 36 on GDX. Let's take a look at GLD. All right, so GLD, I want to see this 175 level break, just because of the strong resistance from back later last year in November. And we're closing below that 2 days now. So I want to really see a break above 175 just because it's such a strong level, right? Which right now is serving as resistance. But if we can get above 175 on GLD, we've got some room to run up into kind of that 177.50 to 180 level or zone. Now, if 175 continues to serve as resistance and we can't break it, lower levels of support reside kind of right around the 171, 170, 150. And that one's really strong due to the range from back in kind of July through early this year. So we've got some levels of support, and that's where scaling, you know, can also be. This is where it can come in handy. If you have a bullish outlook on gold, and we're at this potential inflection point around 175, you want to take a long position, but maybe that doesn't work out initially. If you use appropriate money management and scale in, you don't have to be exactly right. We can be okay with GLD moving lower into these levels of support that reside below 175 and look at those as future entry opportunities to add to the position, assuming that we remain bullish on gold, of course.
All right, let's see. SP wants to see ZIN. Zebra.
ZIN?
ZIM, like Mary.
Oh.
Yep, that's the one.
All right. Zim Integrated Shipping. Not familiar with this name. But big move off 48. So 48 at first glance is the biggest level of support that I'm seeing. We're just still in this red divergence cloud, but potentially it looks like it's fading and we could be moving out of it. But the most recent leg was really down. So what that means is it could just be a retracement off this leg lower. And then we're also hitting resistance. So there was, it looks like a buy Yeah, so there's an open buy. The advance notice came in April 27th, triggered on the 28th. Entry would have been, looks like I can actually go back to the dashboard and look to see what the entry would have been. Buy open 57.51, so right around 57.50, and closed today at 62.48. So what is that, like 5 points? So it's already made a 5. That's a big move off this buy signal, and it's into a resistance area. So again, as it relates to scaling, this could be a good point to scale out of a long position off this buy signal, because we may encounter resistance here. And if that resistance breaks, we may want to leave part of the position open for future profit potential. But if it doesn't, we can at least book profits on, let's say, half the position, and then move our stop to the break even point. So in the absence of any like gaps past a stop order, it essentially creates more of a very minimal risk trade. So what I'm seeing here in terms of resistance, and that was hit today, is right around the 62.50 level. So if 62.50 breaks this week and holds, very bullish. If it gets rejected, then if I had taken a trade off this buy from back in later April, I'd want to be, aggressively moving my stop, probably booking profits on any open profits on like maybe half the position, scaling out, and then moving my stop to break even. But if this 62.50 level breaks, we've got more room to run up into 67.50, which is also a level of resistance. There's a little bit right here around 65. So those are kind of the ones to watch.
All right. Hold it.
Let's take
Take
one more.
Tonight. Yeah, go ahead and
If there is another one.
yeah, let's look at Tesla. Good.
All right. Yeah, so Tesla's, it's so volatile. And if we look at the support, it's a little bit more tricky to see real well-defined support. This one's just, for me, this name is just way too choppy, too volatile. I stay away from it. We just moved out of a green divergence cloud. We did have a nice buy signal in this green divergence cloud back on March 17th. It moved up into a resistance area. There's a sell. We actually have, it looks like, yeah, we're in an active open sell signal right now from here back on April 26th. But you see, this is what I stay away from. You see like this consolidation where it's a lot of volatility because you have wide ranges, but not a lot of directional movement, which can be problematic for obviously a directional trade. But there was a buy signal yesterday. Let me zoom out here, but I just don't see it right now off of any real strong support. I mean, there was some from back in early 2021. It's right around 900. Yeah, as I look at this from a broader perspective, zooming out on the chart, I see that 900 level. So I would say, as long as Tesla stays above 900, this buy signal has some potential, but I would be aggressive with the stop if I were to take a trade off this signal to the long side, with the stop, not far below 900. And I'd really want to see several consecutive closes above 900. We got one yesterday, one today, and we're going to encounter resistance up around the 960, 970 zone on Tesla. So very choppy stock. The broader range is really, kind of between 12 and 13, well, 12 and 1275. And then at the lower end, around 700. So difficult one to trade right now, Tesla, for sure, but worth taking a look at. And certainly one, if I were to trade, would use scaling in and out as a methodology in terms of money management. So let's see. All right. Well, those are good suggestions. Thanks for sharing those and looking at those. We'll wrap up with any final questions for the night. And I think we have some good ideas for topics in future sessions with using some of the techniques we talked about tonight with scaling in and out in a more advanced session with things like options and different nuances to scaling in terms of percentages and levels and things. So I think those are some good ideas for future sessions. Any final questions, Richard?
No, we're set.
All right, awesome. Well, I hope you guys have a great rest of the trading week. And let us know if you have any questions. support@altostrading.com. Let's see, what is next? So next Tuesday, we are starting early. Next is, it's the 10th. So we're actually going to start a session 30 minutes early next week at 6:30 p.m. Eastern time, because we are adding some really cool features to our Zillion dashboard. So we're going to be going over those and what they are. And so feel free to hop on early if you want, but we'll still start our normal live strategy session at 7 Eastern. So if you aren't able to join at 6:30, don't worry about it. And of course, they're recorded, but we are going to start it early, and then we'll just transition over into our live strategy session at 7 Eastern next Tuesday. So we'll be back then. Thanks again for joining, guys. Great rest of the trading week to all of you, and we'll see you next Tuesday.